Good morning, sir. How are you? My name is BeiChen Lin. I'm an associate accountant here at It Makes Sense Financial Corporation. We are a small regional accounting firm based out of Toronto. Want to start by thanking you so much for inviting me here today. I understand that you had some concerns about the profitability of your company, K9 Condos. So I've taken the time to review your financial statements, and today I'll be going over those financial statements and analyzing your profitability. In particular, there are five main points that I wanted to address today. First, I'll start by talking about the nature of making responsible financial decisions. Then I'll go into the need for financial information. I'll describe what the nature of the income statement is. I'll explain some financial analysis applications. And finally, I'll talk about cost, volume, profit analysis. So let's begin. The first thing I want to talk about is why is it important to make responsible financial decisions? And as the owner of a business, you'll have a series of decisions to make. Do you want to expand your facilities? Should you hire new employees? Should you invest in new technology? These are all examples of some of the financial decisions that you'll have to make. And making these decisions can have a big impact on the well-being and success of your company. For example, let's say you decided to invest in an innovative technology, and as a result of that innovative technology, customers have a better satisfaction with your company's pet boarding facilities because they think that the pets are being taken care of better thanks to the new technology. As a result, your revenues are likely to increase and your profits are also likely to increase. So that would be an example of making a responsible financial decision. On the other hand, if you decide to invest in some technology that's maybe not so reliable, or you hire too many employees, then your company might incur more costs than it's necessary. And as a result, you might end up losing money, which is not something that you want, because as the owner of your business, your objective is to try and make a profit. So how do we go about making financial decisions? Well, in order to do that, we need to have financial information. So what I want to talk about now is the need for financial information. Financial information is used by both internal decision makers, such as yourself, as well as external decision makers in order to make a decision about resource allocation. Internal users of financial information, such as owners of a business, will look at a company's income statement, a company's balance sheet, and a company's cash flow statement to decide what are the actions that it wants to take. Does it want to expand? Does it want to hire more employees? Does it want to introduce new technology? External decision makers, such as creditors, so for instance, the bank, they will also want to take a look at financial information as well. The bank would look at how much cash you have on hand. They would look at how much liquid assets you have on hand. They would look at how much debt you have, how much cash flow and profits you're generating, and based on that information, they would decide whether or not to lend money to you. So as you can see, there's definitely a need for financial information from both internal and for external users. So how do we get this financial information then? Well, as you might know, there are three primary financial statements, those being the income statement, the balance sheet, and the cash flow statement. And today, because you wanted me to talk about profitability, I'm going to focus on the nature of the income statement. The income statement is a document that shows the revenues, expenses, and profit that a business earns over a period of time. So for example, a month, a quarter, or a fiscal year. Revenues are the fees that a business earns for providing services or selling goods to customers. So in your case, the revenues would be the amount we charge customers to board their pets within our K9 condo facilities. The expenses are all the costs that the company incurs in order to maintain its business. So for instance, we have to pay the employees who look after the pets, we have to pay for the repairs, we have to pay income tax as well as payroll tax, and we have to pay utilities fees. Those are all just some of the examples of expenses that your business might have to incur. If you take the revenues and you subtract the expenses, you'll arrive at the profit. And profit is ultimately how much money your company has earned, how much you as the owner get to keep in your pocket from your operations. So let's analyze the specific profitability of your business. Based on the information you've given me, I see that you have a revenue of $38,000. I then see that you have several different types of expenses ranging from salaries to cleaning to supplies. And when I add all the expenses together, I get an expenses total of $33,886. Revenue of $38,000, subtract expenses of $33,886, and the profit is $4,114. So from this, we can compute what's known as the net profit margin. The net profit margin is simply your net income over total revenue. So in this case, it's $4,114 divided by 38,000, and that gets us a net profit margin of 10.98%. That means that for every $1 you generate in revenue, you get to keep 10.98 cents as profit. Now, is this profit margin good or bad? In order to interpret the profit margin, we can do two types of analyses. One is called horizontal analysis. Horizontal analysis involves looking at changes in your company's ratios over time. So for example, this fiscal period, your profitability was 10.98%. If last year your profitability was 8.66%, then this shows that your company is becoming more profitable, which suggests that this is a good trend in your company's profitability. Another type of analysis we can do is we can do benchmarking. And essentially benchmarking is when you're comparing your company's profitability to the profitability of other similar companies. So the average profit margin for companies in the pet industry is approximately 10% as well. So that suggests that your profitability is relatively in line with that of the competition. How can we improve profitability though? Because that's ultimately the objective. Every business owner wants to maximize their profit. In order to do that, we have to understand the nature of your cost structure. So that's what cost volume profitability analysis is all about. Cost volume profitability analysis is about analyzing how your profits would change if there were changes to your cost, changes to the volume of products or services sold, and as well as changes to your company's cost structure. So it looks at things such as break-even point, the relationship between fixed and variable costs. When I took a look at your company's costs, I saw that most of your costs, like salaries, would be an example of fixed costs. And that's very typical for the type of business you operate. You operate a canine boarding facility, and so you're going to have a lot of fixed costs like depreciation or salaries expense. And because most of your costs are fixed instead of variable, we say that your business has a high degree of operating leverage or high DOL. And for a business that has high DOL, an effective way to maximize profitability would be try to increase revenue, because DOL is simply the ratio of what is the percentage change in net income over the percentage change in sales. So because most of your expenses are fixed, increasing sales is not going to increase expenses by that much. So you're going to increase your profits by a lot if you're able to increase sales. Therefore, I would recommend you adopt strategies such as having loyalty discounts to encourage repeat customers, or promotions for new customers, discounts for new customers to come in. So today I've talked to you about how to make responsible financial decisions, the need for financial information, the nature of the income statement, analyzing the financial statements, as well as cost volume profit analysis. Do you have any questions for me?
Based on your review of our current assets, do you think we should put money towards advertising or other promotional efforts to increase our profitability? Why?
Looking at your company's current assets, we see that you have a lot of cash on hand. You have a very high current ratio, the ratio of current assets to current liabilities, so assets that can be easily converted to cash over liabilities that are due within 12 months. And because of that, that tells me that even if you were to deploy more money towards advertising, your business would still have enough funds on hand to be able to pay off its creditors. So I believe that it would be a good idea to invest more in advertising because you have the means to do so. And as I said earlier, if you're able to increase your revenues, you're going to see that translate to a very high increase in profitability because of your high DOL.
How often should we analyze our profitability?
We should analyze our profitability on a regular basis, such as every month or every quarter.